Finally, the Dubai real estate market is recovering. Or maybe not. There are many opinions and not enough proof. So my team created this new, data-backed report that will clear things up for investors. I'm gonna walk you through it and share my observations along the way. And the first thing that's actually pretty surprising is rent transactions dynamics. Look at this chart. It shows the average rent price per square foot of new contracts for apartments in Dubai. The blue part of the graph is 5 weeks before the conflict started. The red part is the conflict and post-conflict period. And we can see that when the conflict started, rental prices pretty quickly went below the normal range. It was different for different types of areas and different properties, but overall rental rates went down by roughly 10%. They were below the normal range, but now they're going back to growth. Last couple of weeks we saw pretty good dynamics, and now rental prices are at the top of the normal range. And it's obviously too early to celebrate, but that's not the only sign. Next, let's look at new contract volumes. The latest data we have shows 3.7 thousand new rental contracts for apartments in Dubai. That's roughly 20% higher than 5 weeks ago. We're far from normal numbers. Before the conflict, we saw roughly 5,000 contracts per week, but there is definitely a positive trend. And what we also need to check as we're looking at this data is renewed rental contracts, because the increase in new contracts volume could illustrate that residents are just moving within the city, and therefore it's not a real growth. But here's the graph with the number of rent transactions for renewed contracts. And these are also pretty stable, with overall positive dynamics. And for those who are in Dubai now, it's pretty obvious that many people went back, and the city became much more busy than a few weeks ago. There are a lot of people in the malls, traffic is back, taxi wait times significantly increased. And one of the big contributing factors into that is that Dubai have returned the schools back to the normal schedule. And they also prolonged the school period, busier than usual. Everything I covered now is about long-term contracts, but there are also short-term contracts. And interestingly enough, Airbnb properties are doing much better than a month ago. Look at this chart. In the middle of the March, an average Airbnb property in Dubai had a 35% average occupancy rate, meaning it was empty 20 days a month. The second bar is the data from the last week, and we got these numbers from the same Airbnb operators who shared their numbers with us in the middle of the March. And last week, their average occupancy rate was 62%, and that's actually pretty close to normal occupancy rates. The average in Dubai was around 70–75% before the conflict started. This week we have Eid, a big public holiday, and those property managers we work with, they're telling us that their occupancy rates went up to almost 100%. That's definitely a positive, but that's only a part of the picture, because the Airbnb business is also driven by prices. And prices are growing too. Short-term rentals managers are using dynamic pricing. They're changing them based on demand in order to maximize their profits. And last week, they told us that their prices are roughly 20–30% higher compared to March. So the overall rental demand, which is also a very important market fundamental, is going up. But there is another thing I want to discuss, and the data is not that positive there. And it's also actually pretty misleading. Let's talk about off-plan. And this chart shows the number of transactions in Dubai, in off-plan segment, across apartments, villas, and offices. And at the first glance, it might seem that off-plan transactions are coming back to normal. Look at this big jump in the number of transactions. That week, 2.4 thousand off-plan deals with apartments happened. But what you should know about off-plan transactions data is first that it has a time lag. Those deals that we see now happened many weeks ago. And second, they are not evenly distributed. When I saw this, I asked my team to send me the breakdown of the transactions that happened during that week. And out of 2.4 thousand registered deals, roughly 600 units are units sold in Binghatti Skyflame. It's not like all of them were sold during that week. All of them were registered during that week. And in general, the volume of off-plan transactions is not even close to the pre-war levels. It's obvious when you look at new launches. A few months ago, it was okay for us to see 15 or 20 new launches per week, but in March the average was below 4. So of course the number of off-plan transactions went down significantly. However, in April, developers were more active. We had a week with 5 launches, then 6 launches, and then 7 launches. And these new projects, they're becoming more interesting. Some of them are selling out pretty quickly. For example, Iman launched a new project in GVC. Islington is also coming up with new launches, a new tower in GLT. Imtiaz is launching a new project in Jebel Ali area. And there will be 2 residential towers, but also 1 commercial tower with office space. Modon is having a big launch in Abu Dhabi. Hudayriat Golf Estates. These are villas by the sea and by the golf course. Very interesting projects for those who are investing in Abu Dhabi. Aldar is also launching a new project in between Abu Dhabi and Dubai. There are going to be villas there, and the preliminary prices that we saw indicate that they're going to be priced really attractively. So if you're looking to invest in the real estate in the UAE, there are good opportunities. Also, some of them are not publicly announced. Unfortunately, we cannot talk about them in this video. But if you want to learn more, and if you need data-backed support, feel free to reach out to us. Our contact information is in the description, and you can also scan the QR code. But there are also many investors who are evaluating the risks. And there is one I want to talk with you about, especially that it's one of the most popular ones among our clients. Because when the demand decreases, the number of new launches goes down, developers get much less sales. So the logical question is, how are they doing financially? Will they survive a period of reduced sales for a significant period of time? And what if they'll have no sales at all? And to answer this question, we made a deep dive into their financial data. Some Dubai developers, they're using public markets to get funding. So when, for example, they're issuing bonds, they have to disclose their financials. They're ranked by global rating agencies like Fitch, Moody's, and S&P, and we checked their reports and found some interesting things there. We went through 4 large Dubai developers. They published data about a couple more, but these are the largest, so they're the most interesting ones. And the first one is Emaar. So Emaar is one of those developers who was launching a lot of projects and now significantly reduced their number. In March and April 2026, they've launched just 1 new project. Compare that to the same period in 2025, and they were launching 7. So of course their sales dropped significantly, and their revenue went down. But before that, they have a few pretty good years. And the result of that, take a look at the line 4, is the revenue backlog of $42 billion. What is a revenue backlog? So let's say you're buying a property from Emaar, a $1 million apartment in Dubai Hills. So after some time, you paid 50% of the price, and you have 50% more to go. So you basically owe Emaar $500,000. You'll pay it later according to the payment schedule, partly during construction and partly on handover. So this $500,000 is your contribution to Emaar's revenue backlog. So all such sales combined, all the money they're gonna get from their buyers is $42 billion. That's multiple years of their revenue. And the next interesting thing is how much liquidity do they actually have. So they have $7 billion in cash, 11.7 billion on the escrow accounts, and 2 billion more in undrawn credit. $21 billion in total. All of that creates a very deep cash position. So even if everything goes wrong, they have enough cash to fulfill their obligations and to keep building. So all 3 rating agencies, Moody's, Fitch, and S&P, are pretty positive about their financial position. But they're government-backed. 30% of Emaar is owned by UAE government, so there is no surprise here. What's more interesting is what's happening with privately owned developers. And the next one on the list is Damak. Damak is the #1 private developer in the UAE in terms of its size, and their revenue backlog is $20 billion. So they've basically secured 5 years of revenue. They also have $7.7 billion across escrow accounts and cash, and their financial health is pretty good. They got strong ratings, and they're also gonna pay dividends, roughly 1.5 or 1.6 billion US dollars. They're gonna pay it in 2026. But the next developer is also very well known, but it's smaller compared to those 2 that we just discussed. So it's also interesting to take a look at them, and that's Shoba. Shoba has a smaller revenue backlog, That's equal to roughly 2 years of their revenues. And they have $600 million in corporate cash available. Rating agencies move them to the lower category, but it's not because of their financial position. Their explanation is pretty surprising, and I don't agree with that. So their reasoning is that Shoba represents luxury and ultra-luxury segment, and this segment is hurt most because high-net-worth individuals are reluctant to buy real estate in Dubai. I don't know why they put Shoba into ultra-luxury category, but their prices in Shoba Heartland 2 are pretty close to prices in Dubai Hills. So it's not like they're in radically different price segments compared to Emaar. So there could be different reasons, but definitely not this. And what we see from their financials is that they have enough cash to comfortably go through 2026. And the final one is Bengadi. And Bengadi surprised me most, because they have a different model compared to most other developers in Dubai. They often start selling before they start the construction works. Not always, but they do it pretty often. So this model is great if you're investing, because you get the cash out faster. But it also requires more cash investments from the developer, because they invest before they start getting money from the customers. And if the demand goes down, such companies might need more cash to cover the holes. Now let's quickly look at their financials. Their revenue in 2025 doubled compared to 2024. Their profits in 2025 also doubled, and in 2025 they made 3.6 billion dirhams net profit. That's roughly $1 billion US. And their cash also doubled. They have around $2 billion in cash. They also have $4 billion in revenue backlog, so the future construction works are covered. Their bonds are maturing in 2027, and the estimation by the rating agencies is that they will pay their debt without any issues. So they're also in a pretty good position. And one of the main reasons why developers are feeling that well now is that over the last 5 years, they have a period of rapid growth, of a lot of sales, and they managed to get a large revenue backlog. But another thing is that current regulations in Dubai are very different compared to what we had 10 or 20 years ago. Buyers pay into escrow accounts. Money gets locked into escrow accounts. This money can be only used on construction. Developers' top management cannot buy an island in the Indian Ocean and go and chill there for the rest of their lives. They have to spend this money on construction works. Real estate authorities regulate that, and this money is released only when the construction reaches certain milestones. So when you're investing in Dubai real estate, for sure you should consider a lot of different risks. But the one that the developer will go bankrupt is not present if you're investing in a good developer. And now new interesting opportunities are coming up. One of them is right here. Check it out.